All right, let's talk about a book that is, without a doubt, a legend in the world of finance. Benjamin Graham's The Intelligent Investor. Today, we're going to break down its core principles, timeless ideas that can help you steer clear of some of the market's most expensive, painful mistakes.
And let's just kick things off with this powerful quote from the man himself. You see, Graham believed that all the crazy, manic behavior in the market, well, that's not something you should be afraid of. Actually, it's your single greatest opportunity. We're going to explore how you can flip the script and go from being a victim of market foolishness to someone who actually profits from it. So, first things first, Graham is incredibly clear about this. You absolutely must know the difference between investing and speculating. He says it's the most important choice you will ever make in your financial life.
To really get what speculation feels like, just think back to the dot-com bubble. The whole vibe wasn't about carefully analyzing a business. Oh no. It was about getting rich, like now, with just a few clicks of a mouse. This ad just perfectly captures that feeling. It's all about the thrill of the gain, not the value of the asset. And that speculative fire was fueled by some truly insane numbers. I mean, get this. In 1999, just 1 year, Qualcomm stock shot up over 1,800%. It was all over the news, and people just piled in, chasing that rocket ship, hoping it would take them to the moon.
But here's the thing about rockets built on hype. They have a tendency to fall back to earth. And hard. When that bubble finally burst, that same high-flying stock cratered, losing over 71% of its value. All that easy money just, poof, vanished. It's a painful lesson, but it shows you the reality of speculation. So Graham gives us a really clear side-by-side breakdown. You can see it here. The investor is all about doing the homework, protecting their money, and looking for a reasonable profit. The speculator, they're basically ignoring the homework, staring at the stock price, and gambling on which way it's going to swing. The difference isn't about being smart or dumb. It's about your process. One is a business, the other is a bet.
Okay, now we get to one of Graham's most famous and, honestly, most brilliant ideas. It's a little mental model that is going to completely change how you think about the stock market. Graham asks you to do something pretty interesting. He says, imagine the entire stock market is a person, just one guy, and he's your business partner. Let's call him Mr. Market. Every single day, without fail, he knocks on your door and quotes you a price for your shares in the business. Now, here's the catch with Mr. Market. He's moody, to put it lightly. Some days, he shows up just giddy with excitement, absolutely euphoric. He thinks the future is so bright, he offers to buy your shares from you for way, way more than they are actually worth, ridiculously high prices. But then, there are the other days. He shows up, and he is a complete mess. He's panicking, convinced the business is doomed, the world is ending, and he desperately offers to sell you his shares for pennies on the dollar. It's the same partner, same business, but his mood swings are just off the charts. And this little story perfectly illustrates your single greatest advantage as an investor. You see, you never ever have to trade with him. You can just shut the door. You can ignore his crazy offers and his desperate pleas. Your job is simple. Wait for his mood to create a price that works for you. You buy from him when he's terrified, and you consider selling to him when he's euphoric. You're in control, not his emotions. Okay, so if you're supposed to use Mr. Market's mood swings, how do you know for sure when his price is a real bargain? Well, that brings us to what Graham called the central concept of investment, the margin of safety. Step one is you have to do your homework. You have to figure out a company's intrinsic value, what the business is actually worth, based on its real-world assets and its ability to earn money. Forget the stock price for a second. Let's just say, for simplicity, you figure out the business is worth $1 a share. Now, here's the crucial part. You don't buy it for $1. You don't even buy it for 95 cents. You wait. You wait patiently until Mr. Market has one of his terrible, panicky days and offers to sell it to you for a huge discount, let's say 60 cents. And that difference, that 40-cent gap between the $1 value and the 60-cent price you paid, that is your margin of safety. Think of it as a cushion. It's a buffer that protects you if you made a mistake in your calculations, if the company hits a rough patch, or if the market just stays crazy for a while. It's your shield against the unknown. So you've got this great framework now, right? You understand Mr. Market, you know all about the margin of safety, you're ready to go. But Graham has one last critical warning for us.
And it's that the biggest danger to your money isn't out there in the market. It's staring back at you in the mirror.
Graham was a master of human psychology. He knew that you could have the most brilliant investment strategy in the world, but it would be totally useless if you don't have the emotional discipline and the temperament to actually stick to it when things get tough.
Honestly, it feels like our brains are hardwired to do the exact wrong thing. We get greedy when prices are high and fearful when they're low, the polar opposite of what we should do. We follow the herd right off a cliff, we get cocky, we react to every little news headline. Graham's final lesson is that winning this internal battle against your own worst impulses is the hardest and most important part of the game. So you might be thinking, okay, this all sounds really good in a book, but does this disciplined approach actually work in the real world? Well, let's look at the evidence, laid out perfectly by Graham's most famous student, a guy named Warren Buffett.
Buffett tells this great story. Imagine every single person in the United States gets into a giant coin flipping contest. After 20 days of flipping, just by pure random chance, you'd end up with a couple hundred people who had flipped heads 20 times in a row. You'd be tempted to call them geniuses, but really, it's just luck.
But then he says, what if you looked closer and found that, say, 40 of those winners all came from the same tiny town in Nebraska? Well, then you wouldn't chalk it up to luck anymore, would you? You'd hop on a plane to that town to figure out what on earth they were teaching people there. And that is exactly Buffett's point. He showed that a shocking number of the world's most successful long-term investors all came from the same intellectual town, the school of thought taught by Benjamin Graham. Their incredible decades-long success wasn't a fluke. It was proof that the philosophy, the framework, flat out works.
And that brings us to the real heart of it all. The big lesson from The Intelligent Investor is that the tools are simple. Treat the market like your emotional partner and always, always demand a margin of safety. But the real challenge is internal. The ultimate question isn't what is the market going to do? It's how are you going to behave? Master yourself and you master the game.